Hello friends, if you want to trade in stock market, you can learn the technical analysis from this book. The Technical Analysis of Financial Market written by John Morphy. Here's a summary of Chapter 12 from Technical Analysis of the Financial Markets by John J. Morphy. Chapter 12 Moving Averages. In this lesson, we'll learn about one of the most important tools in technical analysis, moving averages. A moving average, MA, is a line on the chart that smooths out price data over a specific period. It helps traders identify the direction of the trend by filtering out daily price fluctuations or market noise. There are mainly two types: simple moving average, SMA, exponential moving average, EMA. Simple moving average, SMA. The SMA is calculated by taking the average of closing prices over a fixed number of days. For example, a 10-day SMA is equal to sum of last 10 days closing prices divided by 10. It gives equal weight to all prices. When the price is above the SMA, it indicates an uptrend. When the price is below the SMA, it suggests a downtrend. Exponential moving average, EMA. The EMA gives more weight to the most recent prices. That means it reacts faster to price changes compared to the SMA. Traders often use EMA for short-term trading, while SMA is preferred for long-term trends. Common moving average periods. Some popular moving average settings are 10-day or 20-day for short term, 50-day for medium term, 100-day or 200-day for long term. For example, the 200-day MA is a major indicator of the market's overall health. Moving average crossovers. A crossover happens when a short-term average crosses a long-term average. This is a powerful buy-sell signal. Golden cross. When the short-term MA crosses above the long-term MA bullish signal. Death cross. When the short-term MA crosses below the long-term MA bearish signal. Support and resistance. Moving averages often act as support in uptrends and resistance in downtrends. When prices pull back to the MA line and then bounce, that line acts as a support level. Disadvantages of moving averages. Moving averages are lagging indicators. They follow price, they don't predict it. That means signals can come late, especially during fast market reversals. Also, during sideways, range-bound markets, MAs can give false signals. Combining MAs with other indicators. For better accuracy, traders combine moving averages with MACD, Moving Average Convergence Divergence, RSI, Relative Strength Index, Volume Analysis. Conclusion. Moving averages are essential trend-following tools. They help you visualize market direction, define support and resistance, and identify buy-sell signals through crossovers. But always remember, they smooth data, not predict it. Moving averages tell you what the market has been doing, not what it will do. Here's summary of Chapter 13 from Technical Analysis of the Financial Markets by John J. Morphy. Blue Book Chapter 13, Oscillators and Contrary Opinion. Welcome to Chapter 13. In this chapter, we'll learn about oscillators, one of the most useful tools for identifying overbought and oversold market conditions. What are oscillators? Oscillators are momentum indicators that move between two extreme values, usually 0 and 100. They help traders understand when a market is overbought, too high, due for a correction, oversold, too low, due for a bounce. When prices move too far in one direction, oscillators warn that a reversal or correction may happen soon. Purpose of oscillators. Oscillators are most useful when the market is moving sideways in a range. In trending markets, they can stay in the overbought or oversold zones for a long time, so signals may come late. They are mainly used to spot divergence between price and momentum, confirm trend strength or weakness, identify potential reversal points. Types of oscillators. The main oscillators discussed by Morphy include Relative Strength Index (RSI), Stochastic Oscillator Commodity Channel Index (CCI), Rate of Change (ROC), Momentum Indicator. Let's understand each briefly. RSI Relative Strength Index. The RSI, developed by J. Wells Wilder, measures the speed and change of price movements. It oscillates between 0 and 100. Above 70 market is overbought, below 30 market is oversold. Traders watch for divergence. If price makes a new high but RSI does not, it signals weak momentum and a possible reversal. Stochastic Oscillator. Developed by George Lane, the stochastic oscillator compares the current closing price to its range over a certain period, usually 14 days. It has two lines, %K and %D. Above 80 is equal to overbought zone, below 20 is equal to oversold zone. When %K crosses above %D, buy signal. When %K crosses below %D, sell signal. Commodity Channel Index (CCI). The CCI, developed by Donald Lambert, measures how far prices deviate from their average. It's useful for identifying cyclical trends. Above +100 overbought, below -100 oversold. It's widely used in commodity and stock trading. Momentum and Rate of Change (ROC). Both the momentum and rate of change indicators measure how fast prices are rising or falling. They are often plotted around a zero line. Above 0 upward momentum, below 0 downward momentum. When the indicator changes direction, it often hints that momentum is shifting before price does. Divergence, a key concept. Divergence occurs when price and oscillator move in opposite directions. It's a major warning sign that the current trend is weakening. Example: if prices make new highs but RSI or stochastic makes lower highs, bearish divergence, trend may reverse down. If prices make new lows but oscillator makes higher lows, bullish divergence, trend may reverse up. Oscillators and contrary opinion. Morphy explains the idea of contrary opinion. When most traders are bullish, markets often top out, and when most are bearish, markets often bottom. Oscillators help identify these emotional extremes. When everyone is buying and the oscillator is overbought, smart traders prepare to sell. When everyone is selling and the oscillator is oversold, smart traders look to buy. Combining oscillators with trend indicators. Oscillators work best when combined with trend-following tools like moving averages. Use mass to find trend direction. Use oscillators to find entry and exit points within that trend. Conclusion. Oscillators are essential momentum tools that measure the strength of price movements and highlight when markets may be overextended. Oscillators identify overbought, oversold conditions. Watch for divergence between price and indicator. Use oscillators with trend tools for confirmation. Thank you for listening this audio. If you want tea.